Silver isn't approaching $60 anymore. It's pressing on it. We're sitting around $59 an ounce, up roughly 80% this year, and the market keeps walking right back up to that line like it's testing a locked door. For decades, people have said, banks will just sit on it. They'll never let silver really run. But here we are. The old $50 ceiling is broken. Physical demand is stronger than ever. Inventories are thinner, and even with all the usual paper tools still on the table, price has escaped the cage. That's why this video is called $60 Silver is Next. Banks cannot suppress this price surge any longer. By the end, you'll understand what suppression actually meant in practice and why it used to work. What's changed in 2025 that makes those old tools far less effective. Why a push through $60 isn't a wild prediction, but the next logical step in a regime change that's already underway. And how you can respond calmly without trying to copy a trading desk or gamble on leverage. This is not personal financial advice. Use it as a framework, then make your own decisions. 1. What banks suppressing silver really looked like. Let's clear something up. Banks suppressing silver doesn't mean a group of people in a dark room pushing a big red price button. For the last few decades, it's looked more like this. A small futures market acting as the global reference price for physical silver. A handful of large institutions taking big positions on that market, often on the short side. A whole tower of paper products, ETFs, futures, options, unallocated accounts, built on top of a relatively small, slow-moving base of actual metal. In that world, what could big players do? Lean on rallies with heavy short selling when price got too hot. Use complex order flow to nudge price signals. Regulators have already called out certain practices like spoofing in past cases. Rely on the fact that most people never asked for delivery, so the gap between paper claims and real ounces rarely got exposed. Why did this setup work for so long? Because 3 conditions held. Physical supply felt comfortable. There were no obvious, sustained global deficits in silver. Surplus years and stockpiles gave the impression of endless metal. Industrial demand was steady, not explosive. Silver was used in industry, but solar, EVs, data centers, and high-tech electronics hadn't yet become the beasts they are now. Investor demand was occasional, not structural. People rushed into silver during crises, then forgot about it once markets calmed down. In that environment, a paper tower on top of a quiet, physical market could steer the narrative. Look, price says everything is fine, so everything is fine. That world is gone. 2. The 3 forces that broke the old game. In 2025, the tools haven't disappeared, but the conditions that made them so powerful have. 3 big forces changed the story. Force 1, structural deficits. We've moved from some years up, some years down, to multiple years where demand exceeds mine plus recycling supply. That's a structural deficit. Think about that. Every year we use more silver than we bring out of the ground and reclaim. The shortfall comes out of inventories, vault stocks, above ground reserves, and whatever people are willing to sell. For a while, you can pretend that doesn't matter because the buffer is big. Then one day you notice, reported inventories are thinner. The share that's actually for sale is even thinner. And when fresh demand hits, you're not arguing about chart patterns. You're arguing about who gets the ounces. You can lean on price with paper as much as you like. You cannot print metal. Deficits are physics, not opinion. Force 2, industrial lock-in. Silver is no longer just the poor man's gold. It's welded into the solar build-out, EV and battery boom, 5G and next-gen communication networks, high-end electronics and semiconductors, medical tools and advanced imaging, sensitive defense applications. For a lot of these sectors, silver isn't just another input you can swap out for something cheaper next quarter. It's the metal that makes the system work. You don't redesign global solar manufacturing in 6 months because silver is more expensive. You don't rewire EV and electronic supply chains instantly because the input cost ticked up. So even as price rises, a big chunk of industrial demand is inelastic. It doesn't just vanish. That means every dip is an opportunity for industry to refill at a discount. Every surge is a reminder that they might need to secure supply before the next leg up. That constant pull from real-world usage makes it much harder for paper pressure alone to hold price down. Force 3, a more skeptical investor base. After the 2008 crisis, the pandemic money printing, the recent surge in inflation, rolling banking and currency scares around the world, more people quietly reached the same conclusion. I don't just want exposure anymore. I want to own something real. The result? Higher baseline demand for physical coins and bars. Faster and sharper premium spikes whenever price dips. More investors looking at metals as a permanent allocation, not just a trade. In other words, the people who used to disappear between crises are now staying in the room. So now you have structural deficits, industrial lock-in, stickier investor demand. If you still believe the old toolbox can just sit on silver indefinitely in that environment, you're betting against math and behavior at the same time. 3. Why $60 is the next step, not a fantasy. Let's talk specifically about $60. We're not at $18 or $25 speculating about some distant moonshot. We're sitting at $59-ish after breaking the old $50 band that capped silver in 1980 and 2011, running about 80% higher this year alone. From here, there are 3 layers of gravity pulling us towards $60. The round number magnet. Markets love round numbers. $50, $60, $75, $100. Traders place orders around them, target them with option strikes, use them in sentiment. If it breaks 60 then, so once silver has cracked $50, lived in the high dollar 50 seconds, the market almost needs to explore $60 just to see what's there. Where do sellers show up? How do industrial buyers respond? How many leveraged shorts we're counting on it won't get that high? Technically, $60 is the next obvious checkpoint. B. The 45-year range is already broken. The old world was silver lives mostly between, say, $10 and $30. Occasionally, it freaks out near $50 and then gets pulled back. That world assumed abuse of the paper system could keep resets going. Every spike was an error, not a message. Fundamentals didn't justify a higher long-term band. Now we've exceeded that historic band, done it with firmer fundamentals than 1,980 or 2011, seen price hold at much higher levels instead of being instantly rejected. Once you're outside a 45-year range, you're no longer asking, will it go back in? You're asking, where does the new range want to live? $60 is just the first big signpost in that process. C. The pain trade for old assumptions. For years, the comfortable story was, if silver ever gets too high, banks and big players will just push it back down. That belief did 2 things. Kept some people from ever taking silver seriously, encouraged others to keep betting against it with size. Every time silver refuses to obey that script, breaks above an old ceiling, holds higher, comes back after sell-offs with even more real demand underneath. The pain trade shifts. At $59, the market is already forcing a question on anyone who bet on permanent suppression. If they were in total control, how did we get here? $60 is where that question stops being theoretical and starts being obvious. 4. What banks can still do and what they can't. To be clear, banks and large institutions haven't vanished from this story. They still have tools. They can move paper price quickly in both directions. They can raise volatility, shaking out weak hands and leverage traders. They can offer or withhold liquidity, changing how easy it is to get big trades done. So what can't they do anymore? They can't create metal. They can list more contracts, write more derivatives, build more paper layers on top of the same stack. But if deficits persist, industry keeps growing its silver appetite, investors keep stacking, then every additional claim just stretches the same fixed base thinner. At some point, that dynamic stops suppressing price and starts amplifying squeezes. They can't undo physics or policy. No one at a bank desk controls. Long-term energy policy pushing solar adoption, the global shift toward electrification, demographics and aging infrastructure that require more electronics and medical gear. All of that is built on silver. They also don't control. Central bank gold buying, sending a slow, steady signal that fiat is being hedged from the inside. sovereign and institutional behavior that prefers hard assets at the margin. The old playbook assumed a world where those forces were small, slow, and ignorable. We're not in that world anymore. They can't rebuild trust once it's questioned. After years of regulatory cases around metals trading, halts, and technical issues during fast markets, episodes where futures prices and physical premiums diverged, a growing slice of investors have quietly concluded, I don't want my entire hedge inside the same electronic system I'm hedging against. That doesn't mean people stop using futures or ETFs. It means a larger and larger percentage of serious money insists on some real metal, somewhere they can touch or legally claim directly. That shift is slow, but it's cumulative. And once trust steps down a level, it rarely walks back up. 5. How to think about $60 silver without losing your nerve. So, what do you actually do with all this? You don't need to. Predict the exact day we tick $60. Trade every swing. Copy the positioning of a global bank. You just need a plan. Step 1. Decide whether you want 0% in a post-$59 world. Be brutally honest. If silver spends the next decade mostly above $40, $50, with spikes that visit $80, $100, will I be happy that I kept 0% of my net worth in this metal? If the answer is yes, that's your stance. If the answer is no, then do nothing is no longer a neutral choice. It's a bet you're making without admitting it. Step 2. Pick a slice, not a number, on a screen. Instead of fixating on, should I buy now? Or wait until it dips from $59 to $55. Ask, what portion of my wealth makes sense in precious metals at all? For example, 5-10% in precious metals for resilience, with a share of that in silver for more upside potential. The exact slice depends on your situation, obligations, and risk tolerance. But once you pick it and write it down, 2 things happen. You're less likely to panic buy at the top. You're less likely to freeze and do nothing during obvious breaks like this one. Step 3. Separate exposure from ownership. If this whole discussion means anything, it's this. Exposure is price participation. Ownership is control. Exposure lives in futures, ETFs, derivatives, even some pooled accounts. Ownership lives in coins and bars you've paid for, stored in ways you personally understand, with minimal reliance on third parties. There's nothing wrong with trading and price exposure if you treat it as speculation.